All right, all right, all right, all right, all right. Hold on. Oh, hold on. I got a little trick. I messed it up, but I got a trick on you. Ready for this? I'm in my room alone. Anyway, what's up, everybody? Welcome back to another live stream. Man, we have a big earnings call coming up here, folks. It is 3 p.m. Central Standard, 4 p.m. Eastern Standard, 1 p.m. Pacific. And we have Google earnings coming up in about 30 minutes. We got Tesla earnings coming up afterwards. And I think they're going to have a nasty impact on the market. I think it's going to tell us a whole lot about what we need to expect for the remainder of July, going into August, and some more days and weeks following afterwards. So in today's live stream, we are going to go over everything, folks. We are going to do a quick little preparation, have a little mini presentation meant for you all. I didn't deserve that. I have a bit of a presentation for you all where we are going to go over some of the expectations, why tonight matters when it comes to these earnings, what you need to be on the lookout for in terms of the numbers between Google and Tesla's earnings reports. I'm going to talk about an earnings per share trap that you're probably going to see go through today. And then we'll talk about how to handle the reaction that the market's going to give us. Okay. The market's going to get a little crazy. It's going to get a little irrational as a result of whatever they say today. So we're going to run through everything. All right. So that is the game plan. And then we're going to do that for the next 20-30 minutes. And then afterwards, we are going to jump into the earnings report itself. I have a neat little presentation maker thingy that is running. So once this does release, once we do get the Google earnings report released, it's going to run it through and it is going to automatically create a presentation just like this one. So we can easily see all the numbers that matter and all the data that we're looking for. We'll dive in. We'll kind of see how the chart immediately responds, although market will be, of course, closed right then. See how things shake in the after hours, and then we will tune into the Alphabet earnings call. Now, there is going to be Tesla's earnings going on around this time as well, so we will take a little peeky peek into there, but I do believe Google, aka Alphabet, aka Google, is going to be the main event today. This is going to be the thing that we, of course, need to pay attention to, all right, folks? So it's going to be a good show. Hopefully, it's going to be a good night. We're going to see how things go. Seeing a bit of a pullback right now if we look at, all of these different things. We got the S&P 500 pulling back just a bit. We got SPY down the last few hours. Google is currently pulling back into this earnings report. Pretty nasty capitulation here. It's pulled back roughly 6% over the last hour or so heading into this earnings. So people aren't maybe expecting this to head in the right direction, but only time will tell. A little bit of irrational market movement. This is, of course, just positioning. That's nothing more, nothing less. So time will tell. But nonetheless, happy that you were all here. Very happy to see you all. 400 of you in the live stream today. It's pretty dang on cool. So shout out to everyone in here. We got Desian, the homie. We got Jeruf Clay. We're going to go with that one. We got Chad Drake. We got Gandalf in the building. Love to see it. We got Lighty. We got Aladdin. We got, let's see. We got Meta Memester, MT Wolf, Blackshot. Welcome in, everybody. Grab you a little refreshment. I'm going to be sticking to water today. I actually did a bit of a training session yesterday and got overheated. Had a little bit of heat exhaustion. That wasn't good. Got super nauseous. So going to be water for me. But get your refreshment of choice. And we're going to get into it then, shall we? So, what's up, everybody? Wow. What's up? Oh, Kim is in the building. Happy to see you. Let's get into it then, shall we? So why does this earnings report matter so much? This is pretty intuitive. Most of you are going to know this already, but for those of you who don't, let's get into it really quickly. So this is the official kickoff of Mag 7 season. If you don't know who the Magnificent 7 are, we can quickly look at this. The Magnificent 7 stocks are NVIDIA, Apple, Microsoft, Alphabet, aka Google, aka Alphabet, Amazon, Meta, and Tesla. They're the big ones. They're the market leaders. They are the ones who kind of lead this market. They're the ones who can serve as a bit of a strong point here in the market, okay? So it's always important to pay attention to when members of the Mag 7 are reporting their earnings, and that's what we're getting today. We have Alphabet's earnings and we have Tesla earnings that are going to be a very, very strong representation of how the market feels about a bunch of things. We're about to get information about tech. We're about to get information about risk on. We're about to get information about AI, capital expenditure, semis. I mean, we're about to get a lot of information about this market from these two earnings reports, and there's a lot of nuance to it, okay? So it's going to be a very, very important day. Now, the big one that we're going to be paying attention to is Alphabet. This is going to be the big one, aka Google, aka Alphabet. And the numbers are reasonable. I am actually expecting we're going to get a three-piece beat here, right? I think revenue, which is expected to come in at $116 billion, a 21% increase year over year, should be easy pickings for them. I think they're going to clear that. Earnings per share, $2.80. Operational earnings per share expected, which I'll explain that in a second. Very important you understand the difference there. I'll come back to it. Google Cloud revenue, the big one, the big number of the day, $22 billion is what the market's looking for, 63% growth there, all right? Now, as I mentioned before, the big thing is Google Cloud. I'll come back to that in a second. I do want to talk about the earnings per share thing, okay? There's a whole bunch of confusion going around here. The other day I said that I'm looking for an operating earnings per share of $2.87. A lot of people got confused. They said, Tyler, we're looking at $5. We're looking at $8. What do you mean? Remember, Alphabet owns 14% of Anthropic, okay, the AI company, the big one, Claude's thingy, right? Anthropic's value has recently soared, okay, especially as they're preparing for IPO. And accounting rules force Google to book that increase as a gain, although they haven't sold a share and no cash came in. Okay, so it skews that earnings per share. For some people will look at it and some people won't look at it. Very important that you understand that if you're looking at the underlying business of Google, you're looking at that operating earnings per share, which is what I care about. I don't really care about the paper EPS. Okay, very, very important. And of course, Jeff, of course we're live, my homie. So that's the numbers we're looking for. So earnings per share, operating $2.87. That's what we're looking for, folks. All right. Google Cloud revenue is the main number. This is the big number, $22 billion the market is looking for, okay? What does that mean? So in the world of AI, there's this stuff called cloud. Cloud is computing power. Companies like Anthropic and many of these other models will rent computing power, infrastructural space from companies like Alphabet, Google. Cloud revenue is the revenue that was generated by them basically renting out the computing power in which they have created through, of course, the purchasing of semiconductors and other hardware. So a company like Anthropic, when they rent that compute from Alphabet, Google, it shows up as cloud revenue. So it is very important, naturally, to pay attention to what that cloud revenue is, because it tells us about how much demand there is in the market for the things that these companies are spending all this money on. Remember, right now we are seeing companies like Google, companies like Microsoft, companies like Amazon and Meta spending hundreds of billions of dollars. I believe, if I remember correctly, the top 5 capital expenditure-based companies are spending upwards of $700 billion over the next 12 months on infrastructure, on building out these data centers, purchasing, of course, this hardware, the networking, the connections, the memory chips, the CPUs, the GPUs. They're spending a whole lot of money. They're spending a whole lot of money on this infrastructure. So they're providing a lot of supply, right? So the supply side is growing. They're spending a lot of money. That's what CapEx, AI CapEx is, capital expenditure, building out this infrastructure. That's okay, kind of, as long as there is demand. All of these companies that are spending all of this money on AI infrastructure need to see demand. Because all of this invested capital that they're putting in, if it's not returning them anything, is a waste of money. And the market doesn't like that. And it's the exact reason as to why you have seen these moments in which Microsoft and Meta and even Google and many more, when they're talking about spending hundreds of billions of dollars and running out of free cash flow, the market doesn't particularly respond as positively to this, because the market is skeptical. The market is worried. Hey, are these companies going to spend hundreds of billions of dollars, and are they going to make a return on that? What's their ROIC, return on invested capital? What's that going to be? And so, again, it's very important that you pay attention to what the cloud revenue comes in at, because this is going to be a clear representation of demand. Do these companies need what they are building? It's very important stuff. Now, the bright side is there is very likely not going to be any issues here. Okay, there's very likely not going to be any issues here. Remember, the demand is real, and they're sitting on over $462 billion worth of backlog, which, again, against their $180 to $190 billion worth of CapEx, that's pretty reasonably. That's a justified return. But we just need to make sure that that demand is coming in, okay? So although we are going to pay very close attention to revenue and, what's their ads revenue, what's their search revenue, what's their operating earnings per share, we're going to watch that stuff. But we're going to be watching Google Cloud. Now, the next thing that we're going to look for is what they say in regards to the future regarding their capital expenditure. How much money do they spend? How much are they planning on spending? What's their CapEx going to be right now? Planned on being 180, 190. Do they raise it to 200, 210, 220? Do they say that they're going to be spending more money on infrastructural build out? And if they do, how does the market respond? Does the market say, oh, well, they got $462 billion worth of backlog on their current expected CapEx, so ROIC is positive. Why not? It's fine. Or does the market say, no more of this shit? No more of this spending all this money on all this infrastructure until we start seeing real revenue coming in? Who knows? And there's a lot that goes into that. There's a lot of question marks here. You know, Amit, who is, I believe, the GOAT of stock market live stream YouTubers, I take a lot of inspiration from him, even with my titles. So shout out to him. He made a fantastic tweet, and it's so good that I'm going to read the whole thing. Now, look, I ain't the best reader in the world. I was born in Southern Louisiana. Okay. So I don't read the best, but we're going to give it a try. Amit says Google is in a weird position today. Let's say they raise capex from 190 billion, the expected amount right now, to 200 to 220 billion. It would be super bullish for all the semis, but would the market think that's bearish for hyperscalers? Would Meta, Microsoft, Amazon go down on that news because they will be expected to raise? You know, again, if you have Google raising, they need to raise. Google just diluted by 85 billion. So the assumption is they will either increase capex or at the very least keep it flat per their previous guidance. There's no thoughts that they're going to reduce it. Now, let's say Google increases their cloud business revenue growth rate again from the last quarter's 63% to something like 70%, which is amazing growth. But they obviously need to spend more on capex to meet the demand. Does the market think that the capex increase is justified at that point if their cloud business is meaningfully growing? Or in other words, in simpler terms, does the demand justify the supply increase? What if their RPO, which is now 450 billion, goes to something like 550 billion? Oracle and Microsoft increased their RPOs by 100 to 200 billion last quarter, but the problem is most of that RPO is coming from OpenAI and Anthropic. So if Google says the RPO isn't distributed more concentrated, does the market get concerned on that, on if that RPO can convert into actual revenue, or is it just fugazi paper money? We're going for a second. Don't worry. We're coming. Hold on. Last question. Google also had equity stakes in SpaceX and Anthropic, which saw valuation re-ratings that boosted their earnings per share. They won't have it this time. So this is going to be a big one. Let's go. Let's see. The time has come, folks. Give me 1 sec. We're going to get this bad boy pulled up. Here we go. So they have their earnings call coming up in approximately 15 minutes. So we're going to have a second to go through this. Okay. We're going to have a second to go through this, but let's get it pulled up. Let's see what we got. First of all right. So I have the software running right now. It's going to gather that report and it's going to create a presentation. In the meantime, let's see what's going on here. Google giving us a little bit of a spinner. Okay, giving us a little bit of a spinner. Not bad. $343. Bouncing back. Let's check the minutes. 5 minutes. And if somebody wants to drop a quick update, while we're waiting, that'd be great. I'll go into it. But then I'm going to let this presentation create itself. It should be done in like 2 minutes. All right, a little pump and a little dump. Not bad. Okay. Let's see. Here, while that's actually running, we can do this. Google reports $119 billion in revenue for Q2 2026, beating expectations by a lot. So came in at $119 billion in revenue. Earnings expected was $116 billion, so beat by $3 billion. That is not bad at all. Okay. Very good. Here we go. All right. So we should, all right. It is finalizing now. Give it a sec. Wow. Okay. Earnings release. Boom. Bang. Bang. Very good. Okay. This is bullish. We're looking decent, folks. Can we get a round of applause? No, I'm not going to do the round of applause. My bad. All right. Let's go here. Bang. Cool, cool, cool. All right, presentation should be done in a second. It mispulled it, so I'll just pull it up like this for now. All right, let's see what we got. Let's see what we got. Revenue jumps to 119.7 billion. Changes in revenue year over year at 24%. Change in constant currency revenues is fine. Okay. Operating income comes in at 40 billion with their operating margin sitting at 34%. Net expenses. Okay. Naturally, obviously, that CapEx jumps up. Okay. Let's see. Google search and other goes from 54 billion to 63 billion, at a little bit above actually expectations, which is really good. Google Cloud comes in at $24.7 billion, beating our expectations of 22 billion, beat by $2.4 billion. Very good. All right, where'd that bad boy go? There we go. Other bets 382. That's unimportant. So it takes the total revenue up to 119 billion over, of course, the 96 billion. Total TAC at 16 billion compared to 14 billion. Okay, this is the big one here. Google Services, Google Cloud on the quarter alone is good. Okay, so this is a beat all the way across the board, which is, again, is exactly what you would start to expect. Let's see what our unimportant. Okay, here we go. Income sheet. Total cost and expensive. I am looking for net. Here we go, 174. Okay, a beat across the board. A beat across the board. Very good. How are we looking? Looking okay. Looking all right. It's kind of what you would start to expect, though. Let's see. All right, I'm going to see if this came in the right way. Hopefully it's right. If this works, I'm going to use this every time. All right, here we go. Operating earnings per share. This is what I was looking for. Okay, let's see. So actual 119 billion over the 116 billion dollars was a beat. We had operating earnings per share coming in at 285. It's pretty much in line with analyst expectations of 287. Google Cloud came in at $24.8 billion compared to the $22 billion expected, which is very good. Cloud growth up 82% compared to the 63%. So this is a smash, which I'm going to talk about in a second. Operating margin takes a step up to 34% compared to the 33%. That is a damn good earnings report, folks. That is a very good earnings report. I do personally wish their operating EPS came in a beat there. Would have been nice. 287 on consensus expectations. There were lower side consensus expectations, or I guess just expectations at 282, 283. There were some high sides, 290, 291. 285 is fine. I would have been looking for it to come in a little bit higher because this is the number that I personally care about. Again, top line, headline, EPS is fine, whatever. I don't like that whole paper trading. Not paper trading, but paper fugazi stuff. Okay. But 285 coming in is totally fine, basically in line. But the big one here is, of course, cloud growth, 82% over 63%, giving them what is that? What is that? Beat by 10% ish or so, 11% beat here on Google Cloud revenue. Very good. That is a dang good reading. See if there's anything interesting in here that stands out. Let's see this cash flow. Net cash provided by operating activities sitting right at 84. Nice. Other financing activities, same thing. Wow. Wow. Look at that cloud revenue, man. Look at Google Cloud on the quarter. What a smash, dude. Sick. How we got? What we got? Seeing a little bit of a pullback, but I mean, we're basically break even right now. This shouldn't be live yet, right? Oh my God, that's so loud. Okay, give that a sec. Okay. Just seeing if there's anything interesting in here for us to highlight. No, not really. Okay. Wow, what a beat. What a beat. Look at this. It's kind of what you expect, right? It's going to be really interesting. Report. Okay, so you remember I told you all that the EPS was going to come in high. I actually thought it was going to come in around $8. Came in at $9.11. So I was really off on that. That's my bad. But again, as you can tell from the report, that includes a $99 billion gain on equity securities that added about $6.26 to the EPS by itself. And remember, I don't really look at this. I don't really take it into consideration because you have to think about, if you're looking at Google as a company, right? The valuation of Anthropic, which they own about 14% of, that doesn't really give you clear insight into how Google as a company is doing. Like, yeah, it's obviously great for them because the thing that they own is going up in value. But when we're actually looking at the operations of the business, this dilutes things a little bit. So I know. I see some of you saying no, earnings per share is $9.11. I get that. Operating EPS is what really gives you the clear image of how Google as a business is doing. And that came in at expectations, right around a little bit lower than consensus, but around, 0.02 It's really more of an accounting sort of thing. Okay. So don't let anyone tell you this is the key part of this. Like, don't let anyone tell you that Google quadrupled their earnings. Like, oh my God, Google's earnings 4x. No, that is not what happened. They, based on accounting, they have to show that gain on their anthropic position valuation increasing. They have to show it in terms of earnings per share. Okay. So just please be very mindful of that. Okay. But what this did tell us is very important. So cloud didn't just hold, right? We didn't see cloud coming in at expectations. We didn't see cloud coming in slightly higher. No, cloud crushed. Okay. It accelerated to 82% growth, blowing past the 63% expected, with cloud operating income tripling to 8.8 billion on the quarter. And that is very loud. And you know what that tells you? You remember, you remember when I told you that it's a supply demand thing, right? They're spending all of this money, all of this capex on building out this AI infrastructure, right? All this hyperscaling activity. That can only be okay if there is clear demand coming in. You can only spend this much money and do things that you've never done historically before if you have this amount of money coming in, right? If you have real demand coming in. And so what this tells the market is, yeah, these companies that are spending all this money, hundreds of billions of dollars building out this AI infrastructure, it is converting into actual revenue. Will it continue? That's the question people don't know the answer to. But right now, it's doing well. CapEx hit 45 billion roughly in the quarter, and they raised an extra 49.6 billion to fund even more AI infrastructure. Normally, that spend scarce people, but with cloud growth accelerating, this is the exact case where the demand justifies the spend. So not only did they generate more in terms of cloud revenue than the market was expecting, but again, they have raised now 49.6 billion, meaning that yes, they are going to go in and they are going to spend more money on AI infrastructure, right? But I think the market is going to give them the pass on this, the okay on this, because they're making money. It's returning. Their investments are returning. Now, you know what I am curious is how are semis responding to this? Let's see. Um, Nothing super crazy from Nvidia. Stable from Micron. Stable slash a little bit down on AMD. So nothing crazy, not a crazy response. The market seems to be taking this pretty well so far. Let's go back to Google again. Market seems to be taking this pretty well. I actually do like this response. Obviously, there's going to be volatility, and I told you guys, right? There's always going to be volatility, but all in all, the market's performing well. You know what I am actually curious of is how did we perform in previous moments? Like the last earnings call that we, or the last earnings report that we had, how did we respond in that first hour? So immediate pump, pull back, pump. Okay. And then this one was just an immediate crash over the course of 4 hours. So Google's responding well. Market seems to be taking this news pretty well. Obviously, a little bit more of a volatile few minutes here, but nonetheless, they did everything you would expect. They beat on earnings. They beat on cloud. They raised CapEx, which is good for semis or spending. Maybe a little questionable for hyperscalers, but the fact that their cloud revenue is increasing is a good sign. This is what you'd be looking for. I mean, this is in many ways the exact sort of report that you would be looking for if you're in the AI trade or if you're in the hyperscaler trade. The question is, again, how does the market continue to respond to them spending all this money? I think better because they are generating and accelerating in cloud growth. 83%. Was it 83 or 82? 82, yeah. 82% growth. Wow, very good. How are we looking with our fella? SanDisk looking decent, yeah. Seen a nice little run here for SanDisk. Anything here for Broadcom doing decent. I don't think this would have really, kind of. What about our friend SK Hynix? SK Hynix climbing since close. Yeah, pretty decent response from your semis. And that makes sense, right? It makes sense to see, an SK Hynix or a SanDisk, or although they're not particularly showing it too much, it makes sense to see, a Micron slightly positive or an AMD slightly positive, even NVIDIA slightly positive. It makes a ton of sense. I mean, they just announced that they're going to be spending 44 or 49. Which one was it? $49 billion in additional capital capex. They're going to be spending that money. They got to go somewhere, right? So who is down the line from Google? That's why you'll find these semis rallying. And it makes a lot of sense. Again, a lot of the counterweight is, people get upset with these hyperscalers because the hyperscalers are spending all this money, but then they're spending the money on these semis. You know what I mean? They're spending this money on these infrastructural based companies, hardware companies, memory, CPUs, GPUs, etc. And so it's almost like if you're an investor who holds both hyperscalers and semis, it's like taking money out of one pocket and just putting it into the other. This is about as good as a report as you can get. Very good. Very good. Looks like we had some misses from Tesla, which we will get into. I do believe the earnings call for Google is about to start. I am more interested in that personally. I think it would make more sense for us to jump into that. But what we will do is after the Alphabet earnings call, we will go into Tesla's report. Okay. And I'll also jump into ServiceNow as well. Okay. I just think it's important to see where Alphabet is going with all this stuff and give us their insight, give us their take on these earnings. All right, look, this is what we're going to do. Let me get rid of that. Let me get rid of this. Bang, bang, share screen. Entire screen. Bang. Hey, tell me if y'all can hear this music real quick. Could y'all hear that just now? Hopefully. So yes. Okay, cool. So this should be starting in a second here. 1:30 p.m. Pacific is 3:30 my time, I believe. So this should be kicking off in a second. Okay. Shout out to everybody in here, by the way. Sorry, I was a little bit behind. I just wanted to make sure that you guys knew exactly what to expect from that earnings report. I was a little bit behind there. My timing was a bit off. That's my bad. Got to get that posture up next time. But all good. I'm glad we were able to kind of get through it. Glad this little software works too. It's cool to be able to get a auto detection sort of thing going and automatically pulled it. It's waiting for Tesla's one as well. Or I guess it is updated. I need to go download the updated version, but it automatically pulled this Google earnings report and filled in this information. I think that's pretty cool. It took like 4 minutes, but cool to have. Anyway. All right.
That we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Forms 10-K and 10-Q, including the risk factors. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz.
Hey, can y'all hear this?
/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Hi, everyone. Thanks for joining us. We have exciting momentum. Alphabet revenue grew 24% year over year. Our AI investments are redefining what's possible across every part of our business. Our momentum starts with search, where people are adopting one seamless search experience across AI overviews and AI mode. We saw 17% revenue growth in search and other, and YouTube ads grew 13%. Cloud revenue grew 82%, powered by strong demand for AI infrastructure and AI solutions. And cloud backlog grew to $514 billion. It's great to see the wide adoption of Gemini Enterprise, with nearly 90% of Fortune 100 using it. Today, I'll expand on our AI progress, our global product footprint led by search and YouTube, Google Cloud's leadership, and our long-term bets. First, AI. Yesterday, we announced new models, Gemini 3.6 Flash and 3.5 Flash Lite, which are cost-effective and highly efficient. We are seeing tons of demand for our workhorse Gemini Flash series because it hits the sweet spot of performance and cost. We also launched Gemini 3.5 Flash Cyber, which I'm really excited about. Paired with our CodeMender agent, it finds and fixes vulnerabilities and delivers performance at the frontier, comparable to far bigger cyber models. Gemini 3.5 Pro is currently in testing, and our team is already building the next generation of models. We have started our most ambitious pre-training run yet for Gemini 4 and are excited by the progress we are seeing at the frontier. Demand for our models is translating to strong token usage across developers and enterprise customers, and we continue to be supply constrained, a sign of momentum and rapid adoption. More than 9 million developers are building each month with our models across our APIs and key developer products. Our model APIs are now processing approximately 22 billion tokens per minute. That's up from 16 billion just a quarter ago. Additionally, this quarter, we launched Omni. It allows users to create anything from any input, starting with video. Since launching at I/O in May, there's been a 40% increase in daily active users creating videos on the Gemini app. Our Gemma family of open models, small enough to run on local devices, are hugely popular. These models have been downloaded over 900 million times, and our latest Gemma 4 models have been downloaded over 300 million times since launching in April. Our agentic development platform, Antigravity, allows anyone to build in the agent-first era. It has more than 2.4 million weekly active users. Antigravity is a powerful tool for users and enterprises, and it's completely accelerated how we build internally. As just one example, a team in Chrome is now on track to accelerate delivery by 8 times, compressing a 2-year timeline into 3 months through model-driven refactoring. Moving on to our global product footprint, which brings AI to more people than any other company. Starting with search, AI continues to drive an expansionary moment, with new experiences resonating with users and driving growth in queries. As a big football fan, I was particularly excited to see search usage hit an all-time high during the World Cup this year. This really highlights how much people turn to Google in moments that matter. We continue to make search more helpful and intuitive. We recently brought together AI overviews and AI mode into one seamless search experience that combines our frontier capabilities with the best of the web. And we are continuing to incorporate more frontier capabilities into search with agents, personal intelligence, and notebooks. Our AI-powered features are driving increased search usage. Since expanding AI mode globally last October, we have surpassed 1 billion monthly active users. And just like AI overviews, AI mode is driving an incremental increase in search queries overall, and we are now sending billions of clicks to websites every week through AI features in search. As we serve more of these queries, we have continued to drive efficiencies. Thanks to our engineering and hardware optimizations, this quarter we reduced the cost of AI mode responses to its lowest level since launch, even as we have brought more advanced AI capabilities. Philip will also talk more about how we are innovating the ads experience. Next, the Gemini app, which now has 950 million monthly active users, with daily active users tripling in the last year. Users love new agentic features like Daily Brief and our personalized agent, Gemini Spark, which is now available in the US and internationally. We've been shipping helpful new features like this at an incredible clip. On to YouTube. Month after month, when a big event happens in the world turns to YouTube. It's been incredible to see that over 1.7 billion unique viewers globally watched World Cup-related videos on YouTube during the FIFA World Cup 2026. We're also bringing the power of conversational AI directly into the YouTube experience. Ask YouTube uses our Gemini models to let people ask complex questions about individual videos, get quick takeaways, and jump straight to moments in those videos. The early engagement is encouraging. More than 140 million users engaged with Ask YouTube on the watch page in June 2026. and we are bringing that Ask experience to the wider search experience on YouTube. Next, cloud. Our continued momentum is driven by our integrated AI portfolio consisting of chips, models, data, security, and agent platforms, all designed to work together. Gemini continues to be a key driver of growth and is deeply integrated across all of our cloud products, including Gemini Enterprise, data analytics, cybersecurity, and Google Workspace. We are seeing strong, diversified demand across products, customers, geographies, and industries. Our product differentiation is driving expansion in 3 ways. We are winning new customers, more than doubling our acquisition velocity year over year. We are deepening our relationships with existing customers who are expanding their usage and exceeding their commitments by more than 50%. Also, an acceleration over last quarter. We are driving growth with partners, with transactions on Google Cloud Marketplace growing over 7 times year over year. One of the strongest parts of our growth comes from the rapid adoption of our Gemini Enterprise platform. It's differentiated with easy-to-use tools to build agents and automate processes, connectivity to enterprise systems, cost management, and governance tools. In Q2, Agent Development Kit, our framework for building and deploying enterprise AI agents, reached nearly 70 million total downloads. As I said, nearly 90% of Fortune 100 are using Gemini Enterprise. We have customers like PepsiCo for AI and analytics solutions, Intel to streamline core processes, HSBC for wealth management, Bell Canada for customer engagement, Macy's for commerce experiences, and Signal Iduna for knowledge management. More broadly, Gemini is transforming how millions of businesses use AI to build custom agents, automate processes, improve cybersecurity, manage customer relationships, streamline data analytics, collaborate effectively, and more. All of this momentum is driving growth in our paid token usage. Nearly 500 cloud customers have each processed more than 1 trillion tokens in the last year, and usage is so much deeper than that. Over the last 12 months, more than 2,000 enterprises consumed over 100 billion tokens. We're also seeing strong interest in our AI-powered security platform, which is differentiated because it integrates threat intelligence, cyber response prioritization with WIS, AI automated scanning, code remediation, and monitoring. Today, 90% of Fortune 100 are Google Cloud security users. Nearly 90% of WIS customers are using AI-powered security features. And we have seen a more than 45% quarter-over-quarter increase in the number of AI workloads scanned and protected by our security platform. Our security tools are being used to protect critical infrastructure, including financial services organizations such as Morgan Stanley, telecommunication providers such as TELUS, healthcare organizations such as Texas Children's, software companies such as Atlassian, and several government agencies. And with our new Google AI Threat Defense, we are really excited to bring our new cyber model and code mender to help our customers defend against AI threats. All of this is powered by our leading AI infrastructure. We offer the industry's broadest range of accelerators from Google and NVIDIA, including the new NVIDIA Vera Rubin platform and TPU 8T and 8i, which delivers strong price performance. On top of this, let me mention 3 unique offerings. First, our Virgo network, which is designed to meet the needs of modern large-scale AI workloads. It allows customers to connect 1 million AI accelerators across multiple data center sites into a unified supercomputer. Second, our software stack has native support for JAX, PyTorch, VLLM, and SGLang, enabling workload portability across GPUs and TPUs. And third, our new agent-optimized Axion CPU provides 30% better performance per dollar compared to peer offerings. We are seeing strong growth in demand for our AI infrastructure offerings from leading labs such as Ineffable Intelligence, next-generation AI builders, including Kakao, financial services like Deutsche Börse Group, pharmaceutical companies such as Pfizer and Roche, and robotics and spatial intelligence companies such as World Labs. We are continuing our strategy of investing in promising companies and internal efforts that bring pioneering AI research into the real world. We have seen exciting progress from our other bets. Waymo introduced its newest vehicle, Ohio, to public riders. This is the first vehicle powered by the 6th generation Waymo driver and will welcome more riders in the coming months. Wing has safely completed more than 1 million home deliveries, and we continue to grow our presence through partnerships with Walmart, DoorDash, and Papa John's. In health and drug discovery, Isomorphic Labs raised over $2 billion to power its AI drug design engine, scale globally, and advance its drug candidate pipeline. It's truly been an extraordinary first half of 2026, with much more to come. Thanks to all of our employees and partners worldwide for their incredible work this quarter. With that, Philip, over to you.
Thanks, Sundar, and hello, everyone. I'll start with a review of Google services, highlighting our momentum across search, YouTube, and partnerships. Google services revenues were $95 billion for the quarter, up 15% year-on-year, primarily driven by search. Search and other delivered 17% growth, with retail and finance driving the largest contributions. YouTube advertising revenues grew 13%, driven by direct response and brand. Network advertising revenues were down 1% year-on-year. Strong performance in search and YouTube underscores how our investments in AI translate into measurable value for our users and advertisers. Starting with search and other. Revenues reached over $63 billion for the quarter. Sundar highlighted the momentum we see in search, which directly impacts our advertising business. We continue to accelerate the deployment of Gemini across our entire ads infrastructure to boost performance in 3 areas mentioned before: ads quality, advertiser tools, and AI user experiences. First, ads quality. At Google Marketing Live, we showcased how Gemini improves query understanding, allowing us to find relevant ads for longer searches previously difficult to monetize. The core engine of our search ads relies on a dual prediction, delivering immediate utility for the user while maximizing measurable value for the advertiser. Gemini completely supercharges this capability. We use Gemini's advanced reasoning to decode the nuances of longer, more detailed queries. With shopping ads, for instance, we drove a 20% improvement in showing highly relevant ads, helping shoppers immediately find the best match. Second, advertiser tools. Take AI Max. It has become the core building block for advertisers to fully participate in our new AI experiences. It's out of beta, and 500,000 advertisers have already adopted it. Those who adopt our AI-powered campaigns like AI Max or PMax see an average of 15% more conversions or value on search at a similar ROAS. AAA Auto Club enterprises used AI Max to personalize creative assets and capture growth from increasingly detailed insurance searches. This led to a 17% improvement in conversion volume and an 11% decrease in cost per lead. We see strong adoption of our generative AI creative tools, which makes creative development easier, especially for SMBs. In fact, over half of our SMB customers globally use AI to create or optimize their creatives. Third, new AI user experiences. At I/O, we showed how search, including AI overviews and AI mode, works as one connected experience. As you saw from our results, our performance across this holistic system is robust. We continue to be encouraged with monetization performance on queries that show AI overviews, even as we've expanded AI overviews to more commercial queries. Across AI overviews and AI mode, people are asking more specific and detailed questions, providing opportunities for more relevant ads. Within AI mode, we continue to test and deploy a range of new ad formats. For text ads, we improved performance by adding contextual site links based on the conversation. Direct offers is gaining momentum with partners like IHG Hotels and Resorts soon surfacing special offers during trip planning. In highlighted answers, our latest experience, placing clearly marked sponsored links inside list responses, is showing early user traction. Looking at commerce. In collaboration with the retail industry, we established the open source Universal Commerce Protocol, UCP, as the new standard for agentic commerce. Merchants are rapidly adopting UCP, with Target and Steve Madden now live, while new members have joined the UCP Shopping and Food Tech Councils to help steer its vision. We also announced Universal Cart, allowing shoppers to add items from different retailers across Google services and buy in a single checkout. Now on to YouTube. As a FIFA preferred platform partner, we help fans around the world tune into the games. As Sundar mentioned, over 1.7 billion unique viewers watched World Cup related videos, and over 550 million watched them on their televisions. This made the FIFA World Cup 2026 the most viewed World Cup in YouTube history. Advertisers connected with fans through FIFA channel takeovers, Gemini-powered soccer-themed sponsorships, and game day mastheads. And, of course, a huge congratulations to Spain for taking home the trophy. More broadly, on YouTube, we introduced an exclusive slate of creator shows, making it easier for brands to tap into the fandom of creators. We launched custom sponsorships to put brands at the heart of the world's biggest moments as they unfold on YouTube, using AI to dynamically surface videos tailored to a brand's desired moment. Brands continue to partner with YouTube creators to engage new audiences. Kate Spade reached Gen Z through a first-of-its-kind YouTube creator campaign and partnered with creators Ellie Thuman and Hannah Meloche. By leveraging multiple format videos on YouTube, the brand drove a 3.25% brand lift in purchase intent. This unique convergence of brand equity and commercial action makes YouTube a powerful full-funnel platform. SMBs continue to fuel our direct response growth through campaigns like Demand Gen. They leverage our AI to scale visual storytelling across YouTube, Shorts, and now Google Maps. To attract high-value shoppers across North America and Europe, outdoor brand Arc'teryx used Demand Gen to achieve a 70% better return on their ad spend compared to other paid channels. Looking at monetization across YouTube, we're driving sustained growth across our key priorities. In the living room, we see continued momentum across both brand and direct response. With the launch of Buy with Google Pay, viewers can complete purchases directly on their CTV, turning the TV screen into a stronger performance surface. Shorts continues to deliver high-performing opportunities for social and video buyers alike. Beyond advertising, YouTube subscription business, which thrives across living room screens, is growing faster than ads, particularly driven by YouTube Music and Premium. Internally, we leverage Gemini to transform how we work and how we serve our customers. 83% of our sales team uses Gemini-assisted tools weekly, driving up to a 20% higher win rate when using customized pitch narratives. Our ads customer support teams use Gemini-powered agentic solutions that now autonomously address 75% of support queries, freeing them to solve our customers' most complex challenges. Similarly, our new agentic solutions for SMBs have expanded our reach by hundreds of thousands of new customers year to date. As always, ending with partnerships. We're seeing more businesses benefit from the unified strength of Google's AI stack. Booking Holdings expanded a multi-year cloud commitment and are partnering closely to advance our AI-powered ad formats. It's also deploying Google's AI technology to enable new customer experiences like agentic dining reservations on OpenTable, helping restaurants get discovered and booked right when it matters most. In closing, I'd like to thank Googlers everywhere for their contributions to our success and our customers and partners for their continued trust. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the second quarter, unless I state otherwise. I will start with results at the Alphabet level, and will then cover our segments result. I'll end with some commentary on our outlook for the third quarter and full year 2026. We had an outstanding second quarter, delivering our 12th consecutive quarter of double-digit revenue growth. Consolidated revenues were $119.8 billion, up 24%, or 23% in constant currency. Total cost of revenues was $45.9 billion, up 18%. Tech was $16.2 billion, up 10%. Other cost of revenues was $29.8 billion, up 22%, driven by increases in depreciation, inventory costs, primarily from the sales of TPU systems to customers, and content acquisition costs, largely for YouTube. Total operating expenses were up 27% to $33.1 billion. R&D expenses increased by 32%, driven by compensation from investments in AI talent, as well as depreciation. Sales and marketing expenses were up 18% due to investments to support the Gemini app and search and compensation. And G&A expenses increased 24%, primarily driven by compensation and charges for certain legal and other matters. Operating income increased 30% to $40.8 billion, and operating margin was 34%. Other income and expenses was $98 billion, representing a substantial increase from the prior year, primarily due to unrealized gains in our equities securities portfolio. Net income and earnings per share increased significantly, primarily due to the unrealized gains in OI&E I just mentioned. We generated strong operating cash flow of $39.1 billion in the second quarter and $185.7 billion for the trailing 12 months. CapEx was $44.9 billion in the second quarter, with the vast majority of the spend in technical infrastructure to support our investments in AI. Approximately 60% of our investment in technical infrastructure this quarter was in servers, and 40% was in data centers and networking equipment. We had negative free cash flow of $5.9 billion in the second quarter, driven by our investments in CapEx. Free cash flow was $53.3 billion for the trailing 12 months. We ended the quarter with $242.5 billion in cash and marketable securities, which includes $87.1 billion of marketable equity securities. Long-term debt was $98.2 billion. And as mentioned in our press release, our board of directors declared a quarterly cash dividend on our common stock of 22 cents per share, which is payable in September. Turning to segment results, Google Services revenues increased 15% to $94.5 billion, reflecting strong growth in search and subscriptions. Total advertising revenues were up 14%, with growth across all major verticals. We experienced strong ad growth related to the World Cup, particularly in YouTube ads. Google Search and other advertising revenues increased by 17% to $63.3 billion, with retail and finance driving the largest contributions. YouTube advertising revenues increased 13% to $11.1 billion, driven by direct response advertising, as well as brand, with strength in the living room, as Philip mentioned earlier. Network advertising revenues of $7.3 billion were down 1%. Subscription, platforms, and devices revenues increased 15% this quarter to $12.9 billion due to strong growth in both YouTube subscriptions, particularly YouTube Music and Premium, and Google One, which was driven by demand for AI plans. Google Services operating income increased 20% to $39.5 billion, and operating margin was 41.8%. The Google Cloud segment delivered outstanding results in the second quarter, driven by our enterprise AI products and services. Cloud revenues were up 82% to $24.8 billion, driven primarily by GCP, which grew faster than cloud overall. Core GCP, AI solutions, and AI infrastructure were all important drivers of growth. We also began to recognize revenues from TPU system sales, which we delivered to customer data centers for the first time in Q2. Cloud revenue growth accelerated meaningfully even after excluding the impact of TPU system sales. Cloud operating income was $8.8 billion, more than tripling year over year, and operating margin increased from 20.7% in the second quarter last year to 35.6%. Google Cloud's backlog increased by more than $50 billion sequentially, reaching $514 billion in the second quarter. The increase was driven by strong demand for our enterprise AI offerings. The majority of the backlog is related to typical GCP contracts from a broad mix of customers, and we expect to recognize just over 50% of the total backlog as revenue over the next 24 months. In other bets, revenues were $382 million, and operating loss was $1.8 billion as we continue to expand Waymo's business and invest in key other bets. And in Alphabet-level activities, the operating loss was $5.8 billion, driven by shared AI R&D expenses. Turning to our outlook and business performance expectations in the second half of 2026. First, in terms of revenues, at the current spot rates, we would expect a slight FX headwind to our consolidated revenue in Q3 compared to a 1 percentage point FX tailwind in Q2. This impact will be seen primarily in search and YouTube ads. In Google Services, as Philip mentioned, we continue to benefit from innovation in search by improving the user and advertiser experience with AI. At the same time, in Q3, we will begin lapping an acceleration in search performance that began in the third quarter last year. In Google Cloud, we're seeing significant demand for products and services, which we expect to drive strong growth. As I mentioned earlier, we started delivering TPU system to customer data centers in the second quarter. We continue to expect to recognize a relatively small portion of the revenues from our existing TPU system sales agreements this year, ramping as we exit 2026. We anticipate the vast majority of the revenues from these agreements will be realized in 2027. And given the supply-constrained environment, we plan to expand the use of third-party capacity in Q3 as a bridging strategy while we build out more internal capacity. This strategy allows us to keep growing our customer base and capture greater overall value. However, it will create modest margin pressure in the near term as we utilize this capacity. Moving to investments, we are updating our full year 2026 CapEx guidance range to $195 to $205 billion, up from our previous estimate of $180 to $190 billion. The increase in the range is primarily due to an acceleration in the delivery of capacity to meet growing demand. As we previously shared, we continue to expect our CapEx to increase significantly in 2027 and will provide more details at a later date. In terms of expenses, the significant increase in our investments in technical infrastructure will continue to put pressure on the P&L in the form of higher depreciation expense and related data center operations costs such as energy. We also expect to continue hiring in key investment areas such as AI and cloud. And we are investing in marketing to support our AI products. And finally, we expect the free cash flow will remain under pressure, driven by our investments in technical infrastructure, which enables us to capitalize on the AI opportunity and continue to drive attractive returns. Q2 represented another strong quarter. Our teams continue to deliver impressive innovation, executing with discipline and velocity. I want to take this opportunity to thank our employees for their contribution to our performance. Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press star one on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Our first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Thanks for taking my questions. I have two, one for Sundar, one for Anat. Sundar, with more time and Gen AI products and tools in the market and investment continuing to step up, can you just kind of give us some perspective on how your view on the size of the overall Gen AI ROIC opportunity and the timing of the ROIC has changed now versus 1 year ago? And then Anat, you talked quite a bit about supply capacity constraints. Maybe a similar question for you around forward CapEx. How is your budgeting philosophy and just constraints you're putting onto forward spend? How are those changing as you sort of think about the right amount to spend in 2027 to close this capacity constraint?
Look, thanks, Brian. I mean, it's a good question. I do think it feels like we are in very early innings of what feels like secular shift across multiple areas. In our core information businesses, just the possibilities when I see what all you can do with the absolute frontier capabilities, there's still a lot of work ahead to translate all that into experiences for our consumer users. You can think about end-to-end agentic experiences to really meaningfully do a lot more for them. So all of that looks like extraordinary opportunities with extraordinary returns for executing well on those opportunities. Similarly, on the enterprise side, as you can see from our demand, which is reflected in our growth rates, et cetera. Again, in my conversations with many CEOs, many companies, they're all still, barely scratching the early stages of what's possible here. So I think, we used to talk about cloud itself, very few, small percentage of overall workloads in enterprises have shifted to cloud. now think about what percentage of workloads are really AI native and AI enabled. It again feels like very, very early. So I would say, from an ROIC standpoint, I think, we are taking a full stack approach. We are seeing momentum across consumers and enterprises and developers and so on. So it feels like, if anything, over the past year, we've gotten more bullish on the opportunities ahead. I'll turn it over to Anat.
Thanks for the question on how do we think about forward-looking CapEx in the context of supply constraints. So we're still in a supply constraint environment. I think we've said this now for multiple quarters in a row. And we are seeing very strong demand, both from external cloud customers as well as across the business. And our goal is to invest as long as we see an attractive return on that investment, as Sundar mentioned earlier. We do take a long-term view, so we take multi-year view at what the needs are, as well as focus on next year and the near term and building aggressively to meet those demands. And as you've seen, well, we have increased our capacity quite significantly over the past 3 years. The demand still outpaces that investment. And we are, just the rest of the industry, working in a supply-constrained environment. So we're working hard to do this. We do have a benefit of having the full stack approach. So we're able to drive operational efficiencies, technological efficiencies within our technical infrastructure organization so that we can deliver more compute. But as long as we see these attractive opportunities to invest, we will continue to invest.
Thank you both.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. One for Sundar and one for Anat. Sundar, can you just talk about your confidence level that the Gemini models can remain at the frontier? I know you had the Flash model releases this week, but Google perhaps doesn't make maybe quite as much noise as some of the other leading labs, or perhaps have quite the frequency. Just curious how you'd address any concerns about that ability to continue developing leading models. And then just related, can you talk about your plans for coding and how you look to close the gap in that part of enterprise? And then Anat, just following the recent equity and debt raises, can you just help us understand how you think about optimal capital structure and how you view the cost of debt versus equity? Thanks.
Thanks, Doug. Look, I think the frontier is incredibly dynamic space, and it's fiercely moving forward. At any given moment, when you take a snapshot, it feels dynamic. We have had clearly frontier models. There are many attributes on which we are still at the frontier. There are areas where we've acknowledged we need to improve. Coding and agentic coding is an example of that, and I think the teams are very, very focused on it. With 3.6 Flash, and by the way, Flash is our workhorse model, and we see tremendous demand for it, given it generally hits a sweet spot of performance, cost, reliability, latency, etc. And we've incorporated, Gemini and Flash, particularly in our entire portfolio of solutions, be it in cybersecurity, data analytics. If you think about an area like customer service, you need really good voice quality, you need live streaming, you need the ability to reason on that. Or if you're a professional services firm, you need high quality summarization, content generation, etc. So, Flash does very well on all of that. In terms of agentic coding, we are iterating, and you will see us make continued iterations. 3.6 Flash, for example, compared to 3.5 Flash, jumped over, over 10 points in deep SWE as a benchmark, and it is more token efficient doing so. So we are clearly, we are using it internally. We are testing it with many customers in coding. So we see the progress just in 6 weeks from the prior version to the new version, and you will see more continued iterations on that as well. In terms of the frontier, we are both very committed and very confident of being at the frontier. For the next generation of frontier, you're going to need much larger base models. We are now training Gemini 4, and we are being very ambitious with it. I am very excited by the progress I'm seeing internally on Gemini 4, and I'm confident the people will be pleased when we are putting it outside. But we will need Gemini 4 as a larger base model to compete at that frontier level, and so we are focused on executing on that well.
And on the question regarding our capital structure and recent equity and debt raise, so as we think about our investment needs, and as I said, we look at the next year and multiple years out, we first look at how much we can support based on cash from operations. And as you've seen in our results today, we continue to generate very healthy, strong cash flow from operations. So that's our first source of funding. And then we look at debt, and most recently we did the equity raise. And we have expanded our debt portfolio quite significantly over the past 12 months. If you've seen, a year ago, we were at about $16 billion, and we went to about $100 billion across multiple currencies and geographies. So we're expanding that portfolio. But we also want to make sure we have a resilient, not just growth outlook, but also a resilient balance sheet and a strong balance sheet, healthy balance sheet, which is what the rationale behind expanding into the equity markets. At this point, we're not planning to go back to the equity markets, with the exception of, as you recall, part of our equity offering was the ATM or at the market offering that we will do to address the stock-based comp or the tax on SBC, which we'll do for some period of time. But we look at those three dimensions: the cash flow from operations, debt levels, and equity, in a way to balance it in a way that ensures that we continue to maintain a healthy balance sheet.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thanks so much for taking the questions. Maybe two, if I could, both on TPUs. Sundar, can you talk about some of your key learnings as you scale your TPU efforts in terms of both the demand for TPUs and how you think about balancing the external demands for TPUs versus the internal demand for custom silicon inside the organization as you look over the next couple of years? And then, Anat, if I could just follow up, you made some comments in your prepared remarks about the impact of TPUs on Google Cloud. I didn't know if you could give us a little bit more granularity about the size of TPUs as a part of the revenue backlog and how to think about the revenue recognition or the potential for margin impact from TPUs in the years ahead. Thanks so much.
Okay, I think in terms of, first of all, we are very pleased with our TPU roadmap progress and the value in terms of performance, and the edge it gives, and we obviously use it extensively. In terms of allocating TPUs, look, our first priority is making sure we are allocating what we need to compete at the frontier in terms of AGI development, and so that is the foundation for everything we do. But given the extraordinary demand, to balance the external demand, even for most cloud customers, we are using both TPUs and GPUs mainly for serving our models. So think Vertex AI, Gemini Enterprise, the momentum we see. So we're using it or agentic workloads, etc. So we are using it for those purposes. To the extent people want it as infrastructure, we are balancing it by increasingly looking at opportunities to put TPUs in their data centers or in other data centers, like the project we are doing with Blackstone, etc. So we are using that as an ability to balance and make sure we are allocating as much of the available compute for frontier model development, as well as serving both our consumer business and our enterprise business in terms of first-party models.
And in terms of revenue recognition and how we look at the TPU system sales, so the way to think about it is the following. When we sign the agreements that I've mentioned in the prepared remarks, they would be then reflected in the cloud backlog. Now, the vast majority of the $514 billion of cloud backlog is the GCP agreements, but the TPU system sales are reflected in that backlog. We started building inventory to be able to sell those systems. So you see that impact on the cash from operations because we built ahead, obviously, as we're building that business and ramping up. And then once we start delivering the sales, generally, that's when we start recognizing revenue. This quarter was a small amount of the total, that total agreement. Will continue to ramp up throughout 2026, but then you'll see the vast majority of the revenue from that agreements come through in 2027.
Your next question comes from Ross Sandler with Barclays. Your line is now open.
Yeah, just back to the AI model kind of war that's going on, Sundar. Just want to ask about like the speed of model releases and how you can potentially speed up the cadence by which Gemini is releasing models. So we all saw the third-party compute deal with SpaceX. What else are we doing to kind of speed up the pace of model releases compared to some of the other folks out there? And then you just mentioned the Flash models, which have been very successful, to your point. Do you view that as like the right end of the market to be in, given how crowded the lower cost end of the model space has become? Just any thoughts on how you see all that playing out?
Thanks, Ross. Look, I mean, two things I'll say. First of all, we really think about the parade of frontier. We want to make sure for our customers we are offering best models at various price points, right? So you will see us. But it's very important to us to have the best frontier models out there, as well as models which are very performant and low cost. This is why we have Flashlight, Flash, Pro, etc. And with so we are committed to being at the full parade of frontier. On the speed of model releases, I do think you will see us continue to pick up pace. Obviously you've seen us come with we announced 3.5 Flash at I/O. We have followed that up with 3.6 Flash, and you'll see continued iterations of that model with further progress in agentic coding, etc. We are really focused, putting a lot of effort into Gemini 4. It's a very ambitious effort. We wanted to compete at the frontier level of where the frontier will be when Gemini 4 comes out. And so we are applying a lot of our compute and effort in that direction. But with that, we are creating a baseline on top of which you will see us rapidly iterate with subsequent model releases. And so, picking up pace and releasing models, almost at a monthly cadence is part of our roadmap as we are building Gemini 4 as well.
Your next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. Thank you. One for Sundar and one for Anat. Sundar, just keep with the model theme of this call. Can you talk a bit about what do you think the moats are to this new model war? Right? What is your strategic advantages that fuel your business? That even if everyone gets to the same type of model capabilities, what gives you the edge to keep growing like you're doing? And then, Anat, back to Eric's question, anything you tell about the margin impact on TPUs going forward, right? Is it incremental margin to the core cloud margin, or is it a lower margin coming through? Thanks.
Look, Michael, I mean, first of all, look, there are many layers at which we are providing solutions, right? I think part of what the value of our full stack approach is, customers are coming to us for solutions. So if you take an area like cybersecurity or data analytics, people are deploying solutions in which models are an ingredient in that solution, right? So take cyber, people are using Chronicle and Viz, and with our upcoming CodeMender product, they're using it to detect and patch vulnerabilities and so on. Or take data analytics, people are bringing what's been in the past siloed data sources, putting it all together, and having an intelligence layer on top of it with Gemini Enterprise. And so the model is just an ingredient in those solutions. So I think it's important to remember that. Then even within where you're purely on a more model consumption area, people are, there is what looks as models are increasingly becoming end-to-end orchestrated systems, right? Workflows, agentic workflows. And to develop all this, it's your ability not just to bring the compute you need to train and serve, the data quality, the environments you have, your ability to continually improve, provide customers with that peace of mind that all the data they have, their data, their trajectories are confidential to them. None of that in any way flows back to the models. Their ability to configure and serve all this in a secure way and manage it and provision it and so on. So these are big end-to-end things. And so this is what our cloud business as a whole is focused on building it. And, and we are seeing demand across all of these components. And so obviously having our own models allows us to really optimize these solutions and bring an integrated offering. But we will also provide other models as part of these solutions. We also bring infrastructure as part of these solutions, et cetera, and take a whole full stack approach. So I think we are very, very well positioned there.
And on the TPU margins, we don't break out margins for any specific products or infrastructure component. And certainly there are benefits from designing and manufacturing our own chips. But the way to think about it is this is an expansion of our total addressable market. So it expands the opportunities by providing solutions to customers that need those systems in their data centers. But overall, if you think about the cloud margins, obviously a really fantastic expansion of margin to 35.6% this quarter, outstanding, strong operational discipline across the business and leveraging growth in the top line. And now as you think about Q3 and through the remainder of the year, and I mentioned some of it in the prepared remarks, given the supply constraint environment we're in, we are planning to expand the use of third-party capacity in Q3 as a bridging strategy while we continue to build out internal capacity. That capacity, given the cost of that capacity, will put some pressure on operating margins for cloud. And then the last item we mentioned in the past was the integration of Wiz does create some headwind here in the near term in 2026 related to the acquisition.
Thanks, guys.
Your next question comes from Mark Shmulik with Bernstein. Your line is now open.
Yes, thanks for taking the questions. Anat, just on these third-party deals and kind of the bridge and capacity, is there a particular objective where the constraints are most severe, or is it really broad-based? And I guess, stepping back a bit and thinking about capacity allocation across the businesses, has that changed at all, or is there a way to contextualize how you're now thinking about the trade-off between allocating compute to search versus model training versus for the GCP business? Thank you.
Mark, I can comment on it. Look, again, on allocation, I think, the baseline with which we start is what it takes to, continue AGI development at the frontier. Obviously, the priors on that are just based on where the model frontier moves. And so we start with that as a baseline. And beyond that, we want to obviously, we are prioritizing our core product areas like search, YouTube, et cetera, as well as cloud. And within cloud, we are prioritizing the compute to make sure we can serve our models, in the context of Vertex and Gemini Enterprise and our core solutions, be it data analytics and cybersecurity, et cetera, right? So our core serving for our core products across consumers and enterprises where the compute is primarily going, and that's how we think about it. I think on the bridge deal, the main thing I would say is, look, there are on the margin, there are very, very large customers of ours on cloud who we are trying to support them through this extraordinary moment, and the incremental opportunities they are bringing to us, while a short-term cost over a few months may be very high, in the lifetime of the deal, as we bring more capacity on, is highly ROI positive, right? So those are factors we are taking into account. So are you willing to take up front 6-month deal to be able to serve that customer in what is a multi-year opportunity where the margins and the returns are very, very attractive over that multi-year horizon. So hopefully that gives some color on how we thought about those opportunities.
Your next question comes from Ron Josey with Citi. Your line is now open.
Great, thanks for taking the question. Maybe I'll switch topics somewhat and Philip, ask you a little bit more about monetization from a search and YouTube perspective. Just given the greater signal we have with AI searches, and then you talked about YouTube strength. Talk to us a little bit more on how advertisers are leveraging the greater personalization and targeting that Google has to drive this ROAS. And a question we often get is Google is at size and scale. We're still growing 17%. Any reasons what's driving that all-time high on searches? Thank you.
Yes, thank you so much for the question. Look, our 17% year-over-year growth rate in the Q2 search and other revenues was really driven by many parts of our business working well together and very, very deep Gemini integration. Maybe to zoom out for a second, all the major verticals contributed to the growth. Retail drove the greatest contribution. I managed this, followed by really meaningful contributions from finance, tech, media, entertainment, and so on. I think it's really important to understand that Gemini supercharges our ability, and this goes specifically to your question, to understand what people are looking for and match the right ads. So we're applying Gemini models really across our entire ads infrastructure, whether it's ads quality, advertising tools, ads and new AI experiences. And we're really deeply integrating Gemini into the customer tools to make the campaigns more efficient, which comes on top of this. And then we have our AI-powered campaigns like AI Max that help advertisers actually adapt and find the opportunities beyond keyword. Again, that's an ability for us to go deeper and target better. And AI Max continues to unlock, we mentioned this, billions of net new searches that weren't really monetizable before. And then on the YouTube side, high level, the ads growth was driven by direct response and brand advertising. I shared earlier, we continue to see a lot of momentum in the living room. We have a really exciting ads roadmap as well ahead of us on the brand side, on the direct response side. Demand gen and shorts remain really interesting opportunities here. Again, this has targeting components to it, obviously. And we continue to innovate really heavily in direct response with shoppable ad formats in the living room, which will help us drive strength in retail as well.
Your next question comes from Ken Goralski with Wells Fargo. Your line is now open.
Thank you very much. 2 questions, please. First, how would you assess the forecasted returns on compute capacity investments in 27 compared to prior years, 25 and 26, in light of the supply chain constraints and supply chain inflation we're seeing? I'm curious as to how you think about the return profile of 27 and kind of future investments versus past investments in capacity. And the second one, a little different topic here. When you think about Waymo, what are the key factors you would consider when evaluating a change in corporate structure for Waymo? I know you've previously been reticent to talk about this, but the business is scaling. Clearly, there's leadership there and has a lot of momentum. Under what conditions would it make sense for Waymo to live outside of Alphabet? Thank you.
Look, Ken, on your first question, if I understand it, we are working off a discipline ROIC framework here. Obviously, we, to the extent that our input costs going up to us, we reflect that, in our ability to, price our solutions and see returns there. So all of that is factored into how we are planning. I think our compute capacity investments in 27, I think to the first question I answered, I think we are, we are seeing strong demand indicators, including long-term deals, the existing deals which we have, which are renewing, with exceptional demand on a moving forward basis. And so we are using all that to plan and invest accordingly. And so, I think if anything, the dynamics look healthier than where we were about a year ago. And so that's what gives us the confidence to undertake those investments. On Waymo, look, I think we are really focused on executing and scaling up Waymo. We have set it up with our bet structure and given the team a lot of support. Alphabet has continued. I think our ability to think and plan long term and invest in the business is and give them that long-term roadmap. The confidence in undertaking a long-term roadmap and scaling up, I think, is all hugely valuable. We're really focused on scaling the business right now and executing to that extraordinary potential, and that's what we are focused on.
Thank you very much.
Our last question comes from Shrita Kajuria with Wolfe Research. Your line is now open.
Okay, thanks a lot for taking my questions. Could I please ask you two? One is on TPU long-term strategy. Longer term, is it fair to think that as TPU sales scale, you'd build merchant silicon business with a software stack that goes with it? And second is on YouTube revenue. Given how strong engagement is, what are some of the factors that could drive accelerating growth rate at YouTube on a go-forward basis? Thank you.
Maybe I'll answer the first one, and Philip can broadly talk about YouTube revenue growth as well. On the first one on TPUs, look, I think we've been operating with TPUs for a while. A lot of our cloud serving is done on TPUs, and we are also seeing strong demand for TPUs as standalone systems from other customers. And so obviously the industry has constraints too. So we have to plan and we allocate on a forward-looking basis along the principles I spoke about earlier. So I don't want to project out too far into the future there, but I do think we are, obviously we will scale up based on the opportunities we see and the demand we see, commensurate with the constraints that exist and the allocation needs we have for frontier model development, making sure we can serve our consumer businesses and enterprise businesses well. And Philip, you want to add on YouTube monetization?
Yes, thank you so much. So look, I mentioned it, the drivers of YouTube ads revenue growth. I think there's a lot of things we're actually excited about when we look at our ads roadmap here. In brand, we see ongoing opportunities on connected TVs in the living room. We're building tools to help advertisers find creators, scale across screens, and then measure the results. And we have a slate of new and returning creator shows that are coming exclusively to YouTube. We see opportunities in direct response, particularly with demand gen, and Shorts. I mentioned it remain a really interesting opportunity here to expand our base to more small and medium advertisers across more verticals, shorter videos. Actually, this important one, create more opportunities for less disruptive ads, increasing the overall ad effectiveness. So we're going to continue to see a lot of innovation, in my opinion, in direct response with shoppable ad formats in the living room, which, again, we mentioned that drives retail strength. We announced a few other formats here at Brandcast. We announced Buy with Google Pay to enable CTV viewers to actually complete purchases directly on their TV with 2 clicks, which is a really interesting opportunity over time. We launched the Affiliate Partnership Boost to drive incremental sales and the creator earnings, obviously, from YouTube shopping affiliate commissions. So overall, frankly, very, very exciting times.
Thanks, Sundar. Thanks, Philip.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Okay, it's honestly so weird sometimes. Like, I haven't spoken to you all in so long that I forget that I can just speak out loud. Good one, good one. Honestly, I know what the chart says. I actually have some pretty strong opinions on it. I've been studying it for a little bit here. A lot to get into though. Oh man, huh? Good bit to get into here. So let's get this put back together a bit. No need for you. No need for you. Let's throw you back over here. All righty. Well, let's get back into mode, huh? Been quiet for freaking ever. It feels like God. Get a little refreshment in. Beverage of your choice. Okay. Let's recap. I took a lot of notes there, but I didn't get everything, so I will give another recap at some point soon. So, this was a very good earnings report. That is the first thing that I will say. This was a very good earnings report across many different things. For Google, this is a great earnings report, especially when it comes to their search revenue, the fact that Gemini is cutting their margins. Gemini is directly contributing to increases in revenue from search, from ads. Very good for Google, and that's good for the market. You always want to see a Mag 7 company growing. Very good. When it comes to AI specifically, this is good for the narrative, but not enough to break the trend. Sorry, I'm trying to remember everything that happened over the last hour. Good for the narrative, not enough to break the trend. Let me explain. The bet in AI right now is that all of this CapEx is going to produce a different world, right? The bet is that these major companies will spend hundreds of billions, trillions of dollars on AI infrastructure, and it's going to be needed. And many of these models, whether it be Anthropic, whether it be OpenAI, whether it be Gemini itself using its own things, right, will use and leverage this compute to create systems, services, and products that will change the world, whether it be through inference, AI, pushing into agentic AI, whether it be through robotics, or whether it be through any of these things, right? That's what the bet is. The beneficiaries of that will be the people, the hyperscalers, who obviously sell this compute to these companies and eventually do, of course, get a return on that investment. Semiconductors, who provide the material to build this infrastructure. And the companies who obviously present the services and the products, the tools, the AI that is then used. That's the bet, right? This is good for that bet. This is good for that narrative because it means that Google, one of the largest capital expenditures, is continuing to spend. They're continuing to invest into this idea that this is going to work. Their backlog is increasing dramatically, but they simply do not have the capacity to provide for that backlog. Meaning that demand is present and demand is there. It's also good for AI because it means that these major semis, their services are going to continue to be needed. And the cyclicality that typically will put strain on semiconductor-based companies, although maybe not changed or over or canceled, is delayed, extended in some capacity, which is a net positive for companies such as Micron, such as NVIDIA, such as TSMC, whether it's foundry, GPUs, CPUs, memory, connectivity, networking. It's good for all of them because it means that the flow keeps going. The flow keeps going, okay? So it's good for the whole trade. It's just not good enough to break the trend. You see, the reason as to why the S&P 500 is pulled back, the reason as to why Google's down 20% from all-time high to now, 21%. The reason as to why Micron, kind of AMD, NVIDIA, SanDisk, Broadcom, SK Hynix, many of these are down from their all-time highs, is because people are getting concerned that it's not sustainable. The concern that people have is that, one, it's not sustainable, and that's a cyclicality effect that typically will take over semiconductors, especially memory companies, because they're commoditative, will wash, and the end of this run will happen for memory. That's one concern that people have. The other concern that people have is that these major hyperscalers like Google are going to spend all of this money for no reason. That's the concern that people have. They see these cheaper Chinese models, Kimi K3, for example, or previously DeepSeek, which was proved to be not particularly true. And they're concerned that all of this capital expenditure is going to be wasted liquidity. And especially this becomes more concerning when companies are going into debt to facilitate this capital expenditure. It gets much more concerning at that point. If they're funding it with free cash flow, right? But now they're putting themselves financially in a much worse position to fund this CapEx. And the worry that people have is that they're doing it and it's not going to return them money. And because that is a growing concern, because that is something that the market is so worried about, you're in a downtrend. And that was the catalyst. That was just the reason as to why the market's falling. That's the reason why it started. The reason why it's continuing now is because of the fear in the market. The reason as to why we are seeing them continuing to pull back, although we have gotten news that depletes that thought process, is because of emotion. We are in an emotional market right now. A market that expects the best but does the worst. A market that no matter what you say will go down anyway. Emotion is what's leading the market downwards. I don't believe it's fundamentals anymore. Listen, I do think the market got too hot at one point. I think we got a little bit too far. And the questions that people were asking were legitimate. But when I look over the last 2 weeks at these earnings reports and the guidance that we've gotten, all of these major companies have proven that they will continue to build out supply and that demand is continuing to grow and beat expectations. Again, Google's cloud revenue is expected to be 22 billion. It came in at 25 billion, I believe, or 26. That means that demand is continuing to grow as they are continuing to expand their capital expenditure. That is good. That means that there are returns coming on their investments, which is a good thing, especially for these companies. Their debt thing is weird, right? So this is a good sign. And so my takeaway from all of this is that opportunity is being created in the market right now. Opportunity is being created in the market right now in the sense that I personally believe fundamental value is increasing, but emotion is driving price down. And the spread between value and price is opportunity. And so I think you are actually entering into a period of time in which it does make sense to start looking for purchases. Because, everybody points their eyes when it comes to Google. Everyone points their eyes specifically. I said that like a real Southern Louisiana man, specifically at Google's cloud revenue. But they're not paying enough attention to what they just said about Gemini. They said because of our use of Gemini, our search revenue, our search in general, YouTube, etc., all of these things have increased dramatically, meaning that the infrastructure that they're building, which they are then also leveraging themselves for Gemini, is producing higher margins. The bet is working. The question is, does it continue to work? Does it continue to grow? That's what the world doesn't know. But because the world is so scared and emotional, it's just saying, no, it's not going to. Where I'm not seeing the proof quite yet that says that this bet on AI isn't going to work. I oftentimes don't find myself assuming that I know more than the best capital allocators on the planet. I oftentimes find that when people go against the smartest people on earth, they don't win. So when Google comes out and says that they're allocating another $50 billion, no. Yeah. Is that what they said? How much was it? 192. Yeah, whatever. Billions of dollars to continuing to build out CapEx, to expand capacity, to fulfill for this demand. I assume they probably know that this is going to work. They could be wrong, but history has shown that making bets on the smartest people in the world will serve you pretty dang on well. So all of this to say, the earnings report that we got today was great. It was great for the Mag 7. It was great for hyperscalers. It was kind of Google, yes. And it was good for semis, for sure. The market is too emotional to rationalize. And I told you this. If you watched my video yesterday, I told you, do not expect a rational response. Expect the most irrational thing possible. Google just beat across the board and showed that there is very likely continued beating coming forward, yet it's crashing. Although I am not confident that the bottom is in, because this market, cliche saying, this market can remain irrational much longer than you can stay solvent. So although I am not convinced that the bottom is in, and I do not know where the bottom will be in, I do believe that we are entering into a threshold of time in which opportunity is presenting itself for gains to be made over the long term. I think a Google down 21% right now makes sense to me. You see, I sat on this live stream for the last 20 minutes questioning if I was going to buy Google. I literally was like, I might buy Google right now. And I'm not going to go to say I won't. I might. The only reason as to why I'm not right now is because I have a $418,000 position in the S&P 500. Google makes up 5.8% of that, which roughly, I did the math on stream, $24,200, meaning I have a $24,200 current adjusted position in Google as we speak. Do I need more than 24,000? I don't know. I don't know. That's the answer that I have. I don't know if I do. But it's very tempting. Another thought that I'm having right now is swing trading Google. I'm having a very, very impulsive thought that may turn into a not impulsive thought of swing trading Google, opening up some sort of 1x or 3x to 5x leveraged long position on Google with like $500 to $1,000 and just taking a punt. As you all know, I do personally like to swing trade a little. I dabble here and there when I think the opportunity is there. Google and Oracle are the two where I'm questioning it. But I may be making a move on Google soon, especially if Google falls into this $322 to $296 threshold. This is a magnet of a buy zone. It is massive. I don't know if Google comes below it. It can. But the only time in history that we've seen Google within the last 5 years, seen a bigger pullback than that, would be in the 2022 bear market. Are we in a 2022-esque bear market situation? What gets us there? What causes that? I don't know. So I may be making a move on Google soon. Hard to tell. Hard to tell what I'm going to do. I'm not convinced that I'm going to add it to the long-term portfolio. I think if I'm going to add like a hyperscaler or an AI play to the public portfolio that I started only in March, like publicly showing you guys, I would need to see something more dramatic. I like investing in the public portfolio in areas people hate. People hate fintech right now. People hate credit right now. That's my mojo. I'm actually adding American Express pretty soon when I get a buy opportunity. Tricky one. But one way or another, this market is being extremely irrational. And I do think opportunity is presenting itself here. The question is, how much longer does it stay irrational before that opportunity starts to manifest? That's the question. I don't know. Time will tell. I'm giving this an A rating today. I'm giving this earnings report an A+ rating. I think it's good around the board. And I think it's especially good for the stock market. NASDAQ showing it at least. Or it was earlier at least. Hard one. Very hard. Moving on. Tesla. Not too much to talk about here because this thing just got thrown in the garbage. Revenue came in at $28.2 billion on $27.5 billion, which was expected, which was a beat. Everything else basically missed. Our adjusted earnings per share came in at 33 cents per share with expected 55 cents. Gross margin dropped to 16.8 on 19.5. I warned you about this. I'm going to go back into that in a second. Operating margin fell to 1.4% over 5.4% expected. Operating margin. That is not good. 1.4% operating margin. That's gross. You see, Tesla announced record deliveries not too long ago. And when they announced When they announced this, I said, hey, don't get too excited about this yet. Because if their gross and operating margin falls dramatically, this delivery is not all that impressive. Slashed prices will get you records, but it won't get you much else. Tesla seriously missed here. And again, that margin was just simply not good. So not really much to say here. I don't think the market cares. It's just not great for Tesla. You said Tesla just got thrown in the bin. Well, it fell the same as the A+ Google report. That's the I told you. I told you in the video yesterday. I said, don't expect the market to be rational. It ain't rational. We did get an interesting report from ServiceNow, though, for you software folks. Revenue comes in at 3.99 billion vanillis, just missed $4 billion. Embarrassing. Imagine not having that extra couple $1 million in the bank. Loser. 3.92 billion expected, so a beat there. Non-GAAP earnings per share came in at 90 cents per share, beating the 86% per share expectation. Subscription revenue climbs to 3.88 billion, which is the big thing, obviously, for a software company, up from 3.82 billion. This is what you want to see. Revenue up, subscription revenue up, operating margin up, CPRO growth up. This is what you want to see from an AI company. ServiceNow comes in with a banging one. And it'll be very interesting because they beat every metric last time and still crashed 18%. So I will actually be very curious to see how this goes. One thing that is very interesting here is that ServiceNow AI crossed $1 billion in ACV with over 123 deals with $1 million in plus new business. That's 40% increase. So after the IBM scare about software budgets, this is allowed like, hey, software is still alive. Enterprise AI software is still alive. IBM just might not be the place to get it from. Fantastic read from ServiceNow. Stock price not particularly showing it, and I think that could be opportunity. I think there's opportunity here with ServiceNow as well. I think it needed this. I think we got a little bit too big for our britches when it came to ServiceNow back when it was around 200 plus. I think a 200 plus ServiceNow is a little bit of a spooky thing to do, to look for. But in a moment like this with ServiceNow, realistically, I mean, could still have some way to go. I think it is now becoming oversold, though. And I do think we are entering into a opportunistic buy period for ServiceNow. Could be another one I swing trade. Wow. Overall, a great day of earnings for Google. Great day of earnings for ServiceNow. Crappy day of earnings for Tesla. I just don't really think Tesla's that good of a company. I know, I said it. Some of you will disagree. I don't really care. They've just not done so much of what they wanted to do. I think a great representation of a company's success is its ability to accomplish the things that it sets out to do. Not particularly the accomplishments that they do. How capable of accomplishing the things that you want to do are you? Tesla set out to do so many things. I don't remember them all. This was 5 years ago. I don't really remember, but I remember them. I remember it being thrown around like Tesla's going to have 40% of the market share. I don't know what Tesla's current market share is for cars. It cannot be over. If I had to guess, it can't be over 5%. Okay, that might be low. Hold on, let me see. It's 3%. It's 3%. 38 to 46% of the US electric vehicle market, which is great. Don't get me wrong, but they weren't talking about electric. They were talking about cars in general. It's just not great. There were so many of these damn promises. It's like a company that just kicks the can down the road consistently of where the value is like, oh, well, in 3 years, we're going to do this. 3 years later, they're 8% of the total market share that they hoped to be 5 years ago. And I get it, times change. But it's one of those things that makes me weird about SpaceX. Because do y'all feel that? Do y'all feel that? Does it feel kind of similar? In certain areas, we're going to do this. We're going to mine asteroids. Are you? It makes me question them. It makes me question them. I get so much shit because I'm not one of those guys who just like cheers and hoorahs for Tesla. There's like a Tesla cult out there where if you don't say Tesla's great, they hate you. You can hate me. I don't care. But am I wrong in saying that it feels the same? Now, the difference with Tesla, the difference between Tesla and SpaceX is SpaceX has Starlink. That is something I can always get behind. Starlink is amazing. I mean, damn, what a company. I wish I could just invest in a Starlink and nothing else. I don't want XAI. I don't see it being any more useful than anything else. I don't care as much about the other business. I really like Starlink. But it's just the other stuff stains it. And Tesla, dude, it's just like, what the fuck? What? What? Yeah, I don't know. Not my thing. Not my thing. Not my thing. Tesla got big plans. I heard they destroyed car infrastructure and replacing it with robot infrastructure from a room. Just got to take time. But that's my point. It's always a moving of the goalpost. Like, we're going to do this, then we're going to do that, then we're going to do that. And I'm like, when are you actually going to do one of the things you set out to do? You have a great market share of the electric vehicle space. Amazing. Starlink, amazing. And I'm just conflating the two because of Elon. But that's like 10% of what they keep setting out to do. So it's just, I feel like the goalpost keeps getting moved. I feel like it just keeps getting moved over and over and over again. Maybe just me. Maybe just me. But yeah, hell of a day. Hell of a day. How'd the port hold up? Okay, let's see. Public portfolio down a little bit today. Nothing crazy. Let's do a quick analysis session to end the day. Coming up on 5 p.m. Going to be getting some dinner here soon with the wife. Feeling excited about that. Let's see. Oh, pause. Before I do that, I had to shout someone out. DC Fan Forever, member of TH Capital, drops a bombshell on us. $292,000 gain on NBR. Absolutely masterful trade. Risky as hell. Masterful. Absolutely masterful. Beautiful, beautiful accounting. $292,000 gain. 1,000% return. Masterful return. I mean, that is fantastic. Fantastic work there. Shout out to the TH Capital guys. I mean, we got some bangers in here. Gandalf pulling into 2,000% gainer. We got the boy Disco up. We got our boy Coach Will, 25 bandos. Shout out to TH Cap guys. I mean, they're on fire. Speaking of TH Capital, I will also let you know, we are going to be doing a seminar, me and Connor Kinney. This is one of the guys I actually looked up to in the world of investing. It's going to be on taking risks in the stock market, Friday at 9:30 Eastern Standard Time in Market Open. We're going to talk about how we actually take risks in the stock market. I'm going to actually talk about the way I swing trade and the way I will play with options a bit, because I am a creator and an investor who focuses on stable, consistent, cautious investing, but I do take risks. This guy takes risks better than anyone I've ever met. I've watched him with my own eyeballs make millions of dollars in the market. And we're going to be talking about that for an hour, exclusive in TH Capital. So make sure you're there. If you don't know what TH Capital is, it's a community that we've built where you can get access to the things that I'm buying, the things that I'm selling, access to my portfolio. And you're also going to get access to 12 hours of courses on technical analysis, fundamental analysis, portfolio building, introduction to stocks, the basics. That's all available for you there, okay? So check out the link to that is down below. Yeah, if you want to join that. But anyway, let's do a little bit of analysis before we end the day. So SPY, we are currently sitting at a plus 1.24 on the HCI. A little bit high, but nothing super crazy. Looking decent nonetheless. But when it comes to SPY, I have made my positioning very, very clear. Do not get excited about SPY until we see SPY start setting new higher highs. Until SPY can clearly get out of this downtrend, don't get excited about it. These little pumps feel great. They're only going to be followed by dumps. We are setting lower highs consistently. We need to see SPY capable of breaking through any of these highs to change the trend. Until then, SPY is in a downtrend, which is in corrective territory, meaning that you will continue to see it trend downwards. Do not say we're back until SPY is able to break 756. The good part is, though, while currently sitting not far off, only about $10 off, SPY's 4-hour HCI is at +1. Its daily HCI is sitting at -0.7, meaning that it has reset enough to chase down a new high. So we're not back yet on SPY. We are not in buy territory on SPY. We're not in sell territory on SPY. We are in hold territory on SPY. Is SPY capable of coming back up and breaking through that previous high? Going into NASDAQ, the NASDAQ's looking pretty dang good today. The NASDAQ actually did something pretty important. The NASDAQ was capable of going up and actually breaking through that previous high over the last few days, actually breaking up to around $95. The question for the NASDAQ is whether it's capable of maintaining above that golden zone, the Fibonacci golden zone. When I look at it, though, it is one of those situations to where we still need to be cautious. The NASDAQ is, in my opinion, very clearly a hold. The reason why I say it's a hold is because we are sitting at a +3 on the HCI, the Hill Conviction Index, while sitting within the golden zone. If you know me, you know that the golden zone is a major resistance zone that is going to put a ton of selling pressure on the NASDAQ and make it very hard to break it. So when you're sitting directly in a major zone of resistance while you're already at a +3 on the daily HCI, that is a hold or a sell, depending if you're a swing trader who capitalized on this run up, this is a sell. If you are a long-term investor, this is a hold. Okay. Just looking at some individuals here. The NVIDIA price looking pretty interesting on the day. It is also a hold. It is a hold because we are currently seeing NVIDIA trying to break above the head and shoulders line, or the neckline actually, of this head and shoulders pattern, which it has been creating. If NVIDIA is capable of breaking above $214, it does open it up for a potential move back up to around $245, chasing down a new all-time high. There will be landmines in the way with a golden zone sitting directly above us, but this would be a very bullish move for NVIDIA to be able to break above 214, and that would almost be a trigger for me to say that NVIDIA is getting prepared for some type of move back up towards upside. Obviously not a long-term buy. Your buys were going to be when that HCI was lower. Your HCI is currently sitting at +2.21 on the daily chart while you're sitting directly below a resistance level. That's not a buy. That's either a sell for swing traders or a hold for long-term investors to see whether or not it is capable of breaking above that key zone of resistance. If it fails to break resistance, don't be surprised to see it rolling back down to around $198 to retest your failure point of return, which would be that previous right shoulder down here at the bottom side. So a very important moment here for NVIDIA. Breaking 214 insinuates a move back up towards 240 plus is on the way. Failure to break does, in my opinion, send it back down towards your failure point of return and potentially lower as well if we enter into a more macro downtrend here, coming down to take out 190 and likely pursuing 180 to 175. So a very big moment here for NVIDIA. A big decision is being made, hence why I am saying that this is either a hold for long-term investors or a sell for swing traders. Micron is also a hold. Micron is a hold. Yeah, I would just associate this one with a hold. I think Micron is in a decent position. It left buyer's territory. I told you all a few days ago that Micron was in cautious buying territory back down here. When Micron came down to around $800 to $850, I told you all this was a cautious buy. The reason being was because your Hill Conviction Index had fallen to about -3. And we saw it entering back into, of course, your buyer zones. If you remember correctly, we did have that buyer zone printing down there based on this previous zone of resistance, of course. Flip that previous resistance zone into a seller zone, and we got the flip there. So because we did have the buyer zone, and because, of course, we did have the Hill Conviction Index giving us that -3 reading, I told you all that this was a cautious buy. Since those lows to where we are currently, Micron is now up 20%. So congratulations to any of you who capitalized on that cautious purchase. You are now up about 20%. Now we have left buy territory, in my opinion. I think we are now in a hold territory or a sell territory for swing traders. If you caught that cautious purchase towards the downside and you're up 10 to 15%, this would be a sell territory, in my opinion. If it's a short-term trade, simply just because you are now interacting with the sell zone. If we go ahead and turn back on the hill zones, as you can see, we do have a sell zone sitting directly where we are right now. This previous zone of resistance is now on top of us. It doesn't mean that Micron won't break above this sell zone. It just means that it's going to be a battle, and some people aren't going to want to sit through those battles. But it definitely does have legs to break through it, in my opinion. We're only at a -1.56 on the HCI. Definitely room to the upside to continue this move upwards. It is just going to be a battle, and I'm not quite sure if Micron has the legs to win that battle, though I do believe we will get an answer to that tomorrow. So I'm holding here long-term, selling short-term. AMD is still a sell or a hold, in my opinion. As we can quite clearly see, AMD is still sitting in this distribution zone towards the top side. While it's in this distribution zone, what you have to understand is that the people who bought down here are going to start selling to the people who are willing to buy up here. So we are in a distribution period. The question is, are the buyers going to be capable of taking enough of that sell pressure to continue it upwards or not? I don't know, but I'm not going to bet and find out. So if I was somebody who purchased AMD at these lower levels, I would be joining the smart money, quote unquote, and doing some distribution, taking a bit of profit off the table, or just holding. But I would not personally be accumulating AMD here, although it can continue upwards. You see, a lot of people say, well, Tyler, well, if you're saying that you wouldn't be buying, does that mean it can't go up? No, of course it can go up. It obviously can go up. There's a world in which we see AMD pressure back up towards $624 to $681. I think that's more than reasonable, actually, to assume is going to happen, especially considering our daily HCI is at a minus 0.5, and our weekly HCI has now fallen back below 3 to plus 2.39 territory. There is room for divergence. The thing about it is, though, for AMD to make this move upwards, it is just going to be risky. And I don't like buying things when they're risky, personally. Buying something at an all-time high is risky. So not a buy for me. It is a hold for me, or a take profit. Let's do a couple more. SanDisk. I told you all that SanDisk was a cautious buy when it was back at $1,370. From $1,370 to now, SanDisk is up 17%. Congratulations to any of you who got in on that cautious buy. I would go ahead and give it hold territory. I don't think it's sell territory. I would give it hold territory. Let's see if it's capable of breaking through the trend or not. As you can see, it is quite clearly in a downtrend with your trend line being associated with roughly right where we are right now. So I would actually say that this is a sell. This is a short-term sell for my swing traders out there who capitalize on this buy zone pressure. That HCI flipped back to around minus 3.5, if I remember correctly, and took a beautiful run back up towards trend. Now you're going to see SanDisk battling to break trend. I don't like to stick around in these sorts of moments. If I catch a 16% run here, I'm usually going to take my gains on a short-term swing trade. Long-term investment, though, I would just hold, leave it alone, see if it comes back down for more opportunities to dollar cost average in. And the same thing does apply for our friend over here, Broadcom as well. I told you all it was a cautious buy anywhere in this green box, and now it's not a buy. Okay, it's a hold or a swing trade sell. All right, let's jump into our friend Robinhood. Robinhood's coming back down. As you all know, this is one of my favorite positions. Not particularly in a buy moment right now. Of course, you all know I was doing my purchasing whenever Robinhood was ranging between $60 and $75. Now that it is up, this is not a buy to me. We are seeing the weekly HCI at plus 3.37, and we also have that Fibonacci golden zone sitting directly above us right now. There will be sell pressure here that makes me go, Robinhood might come back down. And so because of that, this is not a buy. This is not actually a sell anymore. Now that we are exiting out of the golden zone, this is a hold. SoFi, bit of a fintech play here. Not a buy, not a sell, just a hold. We are sitting currently between a major zone of sellers resistance and buyer support. We're about halfway through it. So we're not in my buy territory yet. And the HCI is coming back down into neutral territory. So not a purchase for me right now. Neutral. Looking at Meta. I told you all that Meta, in my opinion, was a sell for swing traders or a hold when it was back up here because it did have, of course, this sell zone resistance sitting directly above us in line with the golden zone. It is now being rejected off of it. This is not a buy. This is not a hold. This is not a sell. Or sorry, this is not a buy. This is not a sell. This is a hold now that we are being rejected and coming back down to pursue buyer side support. Apple is running up. Apple is continuing to show divergence on the weekly time frame. As you can see, we are now seeing the HCI actually trending lower as it is trending higher, meaning that this move towards the upside is actually showing divergence. And when you see that sort of divergence, that usually is a signal, a sell signal. So Apple is a sell for me. Apple is never a sell. You're always supposed to buy Apple and never sell it. But if I was going to do something, I would be selling it or holding it for the long term. I would not for any reason, be buying Apple currently at $325. Not to say that it can't continue upwards. Again, it just means that it is going to be harder and harder for it to go up every day. The risk becomes higher and higher. Google. Told you about that one already. Tesla, I wouldn't touch this one right now. ServiceNow. As tiny of a buy as humanly possible. The most cautious of buy territory. I would probably be looking to accumulate ServiceNow back into this buy territory down here. I have a feeling it might want to come down into it. We'll see. And yeah, that's my major ones. That's my major ones so far. So that's where we are with the vast majority of them. We are no longer in our short-term buy territory for most of these. We are in the let's see what happens phase. It's going to be very interesting to see as the week goes on how we see certain stocks like Micron, AMD, NVIDIA, and more reacting to this sell territory sitting directly above us. Again, congratulations to any of you who did recognize this overreading or this oversold reading on the Hill Conviction Index representing a potential buy territory, a cautious purchase. It does not work 100% of the time. There is not an indicator on the face of this planet that works 100% of the time, but it does a damn good job at representing these areas where it could be a good buying opportunity. And those of you who capitalized on it are looking at some decent 15 to 20% gains. So congratulations to you. If you don't know, by the way, I guess I didn't really talk about this. If you don't know what the Hill Conviction Index is, if you don't know what the Hill zones are, all these things that I keep turning on, this is a set of tools and indicators that I've personally developed over the last 7 months. It cost about $8,000 roughly to develop, just paying developers and then eventually meeting a good partner to handle the expenses. About $8,000 or so in 7 months of development to make it do my technical analysis for me. What it does is it tells me when a stock is getting too high, which is represented by the meter going into the plus red, when a stock is getting too low, which is represented by the meter going into the minus green territory. It also tells me where the buyer and seller zones are. This is where the sellers are going to sell, the red lines. This is where the buyers are going to buy, the green lines. It is something that I went public with on Friday. We have currently gotten over 100 signups. 100 people have purchased the toolkit. So shout out to all of you who are using it. I know many of you are using it well. And if you do want to use it yourself, there's a link down below to the TH toolkit. It is a one-time purchase. You do not have to pay it monthly. It's just a one-time purchase. Feel free to check that out down below. But with that in mind, folks, we are now 2 hours in. And I am quite exhausted. I'm going to be 100% honest with you all. I've been up since 4:30 in the morning. I had a really bad battle of heat exhaustion last night from training. It was sucked. I've never experienced anything like that in my life. I couldn't cool down. It was very weird. I was super dehydrated, but my mouth was watering. I felt very nauseous. My vision was a bit blurry. I couldn't cool down. That was the biggest thing. I've never experienced that before. I didn't sleep super well last night as a result of it. So it has kind of thrown my body off a bit today. So I am going to go ahead and take a bit of a break. I hope you guys did enjoy today's live stream. We've been hanging out for 2 hours now. So thank you all so much who have been in here. The only thing that I do ask really quickly, if you did enjoy today's video, if you did enjoy today's live stream, if you like this video on your way out, what's going to happen is it's going to shut down the live stream and then it's going to treat the video like it's going to treat the live stream like a video. So it'll start pushing it out to other people out there for them to come rewatch it. Okay. So it is very helpful if you do just like the video. That's all that I ask if you did find it valuable. When you do exit, if you want a little bit more content from me, although I don't know why you'd want to hear my voice after 2 hours anymore, don't forget there is that free educational playlist on the channel. If you go ahead and give it a click, there are now 7 videos, which are about 20 to 30 minutes long, teaching you the different things that I personally use to develop my portfolios here in the stock market. These are the exact metrics, tools, and strategies and skills that have allowed me to generate $64,000 over the last year, which is not a fantastic game, don't get me wrong, but it is a game that I am proud of. And if you want to learn the things that I'm doing, feel free to check it out down below. But with that in mind, I appreciate you all so much for joining in. One shout out to all of these homies in here. Break Time with Beanie, PT Deep. We got Adam. We got Volk. It is a plugin for TradingView. We got, we got Volk again. We got Jeff Clay. Shout out to you for staying up all night. Google is a cautious buy, in my opinion. And yeah, thank you all so much. But I appreciate you joining in again. I hope you guys do have an absolutely, absolutely fantastic rest of your day. Get you a good old beverage in. And I can't wait to see you all in the next one. Peace out.